Good evening, everybody. Tonight we're going to kind of look at some option strategies, and this is all getting ready for our two-day training session for May 2nd, not two-day, a full-day training session. So you don't want to scare too many people off. When we did the 1-hour session last weekend, it only lasted 4.5 hours. So this one's advertised as a 3-hour session. So here are some option strategies. A lot of people kind of, when they're new to options, or even the more experienced traders, will always go straight for the calls. But we're going to be looking at something different. So using candlestick analysis, we have three major advantages. One, we know the direction of the move with a high degree of probability. And two, we can pretty much factor in the timeliness of the move. And three, we can evaluate pretty accurately the magnitude of the move. Joe, yep, we're going to be looking at some of that. So, got 4 different strategies. Buying the calls and puts outright at the appropriate time. Okay, hang on to your individual stock requests until I tell Jim to do the double line. We're going to be going through PowerPoints, which are already kind of set, and then we'll go to live charts after that. Buying spreads, selling spreads, and a combination of both. So the reason for that is that everybody says, oh, stock's going up, let's buy the calls. That's probably correct about 20, maybe 25% of the time. These other strategies have much more logic, or a lot more risk-reward factor to it. Yes, you get this. If you do the Saturday session, you get a 30-day free turnout to the options area. JC, I don't know what that means. What about risk reversals? Does the sound a little bit distorted? How about that? Any better? If the sound is distorted, it might be because we're using, I might just have to turn off the video of me. All right, maybe I got the sound better. All right, so first of all, we've got the advantage that we've got some very simple scans that we can find. Whether you're using Think or Swim, you can put in your scanning, you find the best trades, find what type of setups you're looking for. So the advantage I've always discovered with candlestick analysis is you've got some very relevant decisions that can be pretty well illustrated with the candlestick signals and patterns, which is being able to see what amount of time we have to expiration and what strike price is the best trade. That's the question that most people ask when you say, oh, I'm buying some calls or I'm buying a bull spread. They ask, well, what expiration time and what strike price? So that we can clear up very simply with candlestick analysis, which means our timing and our targets are very easy to identify. So if I'm buying calls, or if I've got something where I've got the expiration date that I'm looking at, or what I use is 4 weeks or greater, I might just buy calls and puts outright. If it's a shorter time frame, like 2 or 3 weeks out, I'm probably using debit spreads. And if it's a very close in, like 1 week or just over 1 week, I'll probably do credit spreads. So what we try to calculate on a pattern breakout is what would be the magnitude of the move, how far out. So now we've got ways to calculate that based upon the strength of a first move or the strength of a breakout. Let's see. Risk reversal is options trading strategy that aims to put on a free options position, which is one where you either pay or receive upfront payment for the. Well, I'll let you teach us on that, JC. Okay, Brad, I'm sorry. So here is the most. Now, this is the second most important aspect of option trading, is the math. We can identify price moves. So now we can calculate what type of spread or what type of trade we want to put on. So, for example, a while back, Amazon, when it started off this bottom off the 50, we were looking to buy them. I guess this was back in March. May have been March last year. I can't even remember. But the calls were trading for $9.30 with the potential to go up here to $17.30 to take those calls to $30. That seems all right. But when we look at why a spread versus a straight call position, the math and the risk, it makes it much more clear. So if we can figure out what our target is, if we were buying the calls, our call spread here, and this one's out of position, to make the same profit on a spread that would have to only go to here, the same price move would have to go up here just buying the calls outright. So let's take a look at that. When we look at a situation for a spread, obviously you've got all sorts of time frames. So that's what we want to look at to see what time frame. So if we're looking at kind of a J-hook pattern, we can pretty much calculate how many weeks it might take, or 1 week, 2 weeks, 3 weeks, to get to our target price. So the spreads have advantages. We're going to go through that real quick here. The spreads have three major advantages. One, you've got less money exposed to market risk. Two, the percentage return is greatly enhanced with a much lower price target. And three, your break even is much lower. So that's where we put in the math. So again, if I've got 4 weeks out, I'm buying calls and puts outright. 2 to 3 weeks out, debit spreads, and a shorter time frame, credit spreads. And we'll show where they all work effectively. So let's just say, for example, we're doing bull call spreads. For those that are not familiar with a spread, it's basically when you're entering or buying or selling equal numbers of options of the same class and the same underlying security, but at different strike prices. So here's an example. Let's say a stock is trading at 50, and we think the target is going to be 55. If we bought the calls outright for $2.50 to the time we get to expiration, and it hits our target price of 55, your $2.50 has now gone to a $5 price, where you've made a $2.50 profit or 100% gain. And your break even, when you were paying $2.50 for those calls, would be that the price would have to go from 50 to 52.50 just to break even. Now, if we did a spread with the stock trading at 50 and the target 55, let's say we bought those calls for $2.50, but we sold the December 55 calls for $1, so we've got $1.50 net into the trade. Now if it goes to our target of 55, and that $1.50 now goes to $5, or you made a $3.50 gain, where your profit now is 275%. and your break even was 51.50 instead of 52.50. Now, when I put on a spread, I usually want that spread to make a minimum of 2.5 to 3 times the money. So on a spread that is a $5 spread, that means I'm probably not going to pay more than $2 for that spread, just because of the hurdles that you have to go through to get a profitable trade. If people are asking, well, why not? Isn't a 50 for 100% profit good? Why is that a bull call spread? Because you're buying a bullish spread with calls that you anticipate going up higher. So we were buying, on this one, we were buying the December calls, and we were selling the December 50 calls and selling the 55 calls. So that's a bull call spread. Now, what we're going to be doing is we're going to be analyzing which strategies are working for or work best for a pattern that we can see might have a big, huge upside. So a 5-pan bottom breakout, what is expected? This big, huge move. And there's a multiple number of strategies. And I say multiple number of strategies. It still boils down to buying the calls, buying full spread somewhere up here, more than likely in that bullish situation. Jake, yes. When you're putting on a spread, when you're buying an option, anytime you're putting on a trade, you're doing it based upon the underlying stock. So all you're doing really is buying that stock with with options. So if you were buying a position because it was a good buy when you saw a sell signal, you close out your option position. Jeff, yes, we do futures in the options room. So we were looking today at crude oil prices as well as, I think no, you don't. I'll go to some of those in the live charts. But in the options room, it's not nearly as big as the regular rooms. There's about 20, well, I guess we got 40 people in there. How do you close out a position? Just like you buy it. And, and I'll show you how to do that here in a second with another chart. For a fry-pan bottom, is there a way to project? No. If I see a fry-pan bottom, this is what I expect. I don't know how long it's going to last, how long it's going to take. So we do a different strategies here. If we've got a J-hook pattern, we've got different option strategies that we want to use on this one because we can kind of calculate what the magnitude of the move will be. So when we have that price move expectation, again, we come back to the math. So there's a lot of stocks that I like to trade, or I would trade, but the options are just too expensive. So here's what we were looking at on Zoom over the last few weeks. We saw when it reversed right off the bottom. That was our recommendation in here. Then we had a J-hook type pattern, and this is why the first analysis is what is the chart pattern telling us? Now, how do we fix or how do we set up the best trade setups? Trade setups. Victor, real quick. A debit spread is when you put money out of your pocket. A credit spread is when you do it and you put money in your pocket. And I'll get to that here in a little bit. So we bought some calls down here. Wanted to buy more calls because where do you think our target is? Probably in this trajectory. Or a wave one, wave 3 taking you up here somewhere. So if I'm looking at the prices of buying a May 165 call for 18 bucks, I can't buy a whole heck of a lot. And if you've got a small trading account, buying one option at 1,800 bucks or 1,850, that's a lot of money. So what's our next strategy? We go to a spread. And this is fuzzy, but this would be buying the 165 and selling the 175. Why would you choose 160, not 175? At the time I was looking at this today, it was trading down here. Now you could go to the 175, but you're still paying $1,300, $1,400 per option. So if you've got a $50,000 option trading account, that doesn't bother you too much. Are you having a stroke, Bruce? I don't know. So I look at this and say, man, that's pretty expensive. Or that might take up a good percentage of my trading equity in my options account. So let's look at a spread. Well, the 165, 175, trading at 550 or 505. We'll get to that, Xavier. Hold on. That's pretty expensive. Now, when I look at this analysis, and it was trading right here at that time, or even trading here, and I think it's still got another 40 points to the upside, still pretty expensive on these options. So I take a look at the 165, 175. What's my parameter? Well, if I don't want to spend any more than $2 to make $5, I don't want to spend any more than $4 to make $10. So that's too expensive. So now I can start going up the ladder and say, well, here's the 170, 180, 420. That's putting it kind of in the range. Do you take delta into consideration? No. Remember, anytime we're buying a candlestick pattern, we're expecting something a lot different than what the previous delta was. We're probably going to get a lot more exuberance now in that new trading pattern. So here we've got 420. That puts it right on the cusp. You know, you don't want to spend any more than $4. So that may get reasonable. Or maybe I go to the 175, 185. Now this was done tonight when the price was up here. So it's closed today at, where did it close? At 169. So let's say I'm looking at this, which now isn't too far out of line because it's only $6 below where it closed. And can it get to 185? That would probably be a reasonable move. So here's what my spread difference would be. Today, when it was at 160, I started picking up the 165, 175s at 380. Again, that's below my $4 limit. Yeah, they will. But this is not a debit spread, Cindy. This is a credit spread. So they don't have to lock up any of your equity. The only equity you're using is what you're paying for the options. So let's say we bought one call at $3.80. That would be paying $380. Now, if the price goes up above 175, that 380 now goes to $10 at expiration, which means we made $6.20 or 163% profit on that trade. If I had bought the calls the 165 is at 14, to make the same profit, the stock now has to go to 188 to make that same percentage return. So you can see the difference there. I can make just as good a profit, or a good profit, but with a spread, as the same price move just buying the calls outright, having to go up much higher from that point. And your break even would be simply that the stock, when it was trading at, or buying the 165s, 175s, just to get my $3.80 back, the stock would have to close on expiration date above 168.80 to get my 380. That's the 165 plus the 380. Versus if I paid $14 for the 165 calls, it has to go to 179 just to break even. How do you know the call will, because that's the maximum price of this call, the $10 difference. Because if this stock goes to 180, let's say, so much can happen before expiration. Yep. Let's see. Let me go back. Elaine, if this stock goes to 80 on expiration day, what is your 165s worth? They're worth $15. So you could sell those for $15. But you'd have to buy back your 175s, and how much are they worth? They're worth $5. So that's $15 that you're putting back in your pocket, and you're paying back out $5. So you're going to net $10. So your maximum profit is $10. You can sell it at any time, yes. And you can see this screen here. This is on Thinkorswim. I use Thinkorswim as my trading platform. So if I see this and I want to buy that, or buy the 175s and sell the 180s for $3 to have that go to $10. Well, let's say in 5 trading days, the stock looks like it's peaking out, and I put a sell in for my spread. It might show that I'm going to get $5.40 for it, since it went up, but it didn't get to our maximum. So I just put it in, and they close it out at $5.84 or whatever I said, $5.40. So when you put in the spread, they'll show you what price you can get by buying these and selling these. And this is a debit spread, yes. This is that you're putting $3 out of pocket, and I'll get to the credit spreads here in a minute. So now the reason we're doing this tonight is got a lot of questions. And before, we've tried to do a couple of these strategies in one night. And if people don't understand one strategy, they get confused on the second strategy. So I'm intentionally confusing you, because once you know these strategies and you can kind of factor them into your own, or you understand them, it becomes much easier when we start looking at which are the best ones, which strategy do we put on. So ZM has to close above 165 to be profitable. No. Remember, you paid $3.80 for the spread. So if on expiration day, to break even, it has to close at 168.80, because that means your 165s are going to be worth $3.80, and your 175s are going to be worthless. So it has to close above 168.80 to break even, get your money back. Anything above 175, you're going to maximize your profit at $10. No, that's a call spread is a call spread. That's apples and oranges. A debit spread is when you put money out of your pocket or out of your account to buy that spread at $3.80. Yes, your maximum profit is going to be $6.20. No matter where, anything above 175 is going to maximize your profit at $6.20. I'm using the May monthlies, which I think is May 15. Now you can do a spread either before. I mean, you might want to do 2 weeks out, and that's what we're going to go through on Saturdays or the next Saturdays. Which ones do you want to? Which ones is what do I want to say? Fits into your risk tolerance. No, you're talking the wrong thing, Rajan. If you have a $4,000 option trading account and you decide to buy a spread for $380, that's how much money you're going to have to spend on that spread. There's no margin. You're paying cash for that spread. Richie, that's what we'll figure out. And again, that's each person's individual risk tolerance. I'm picking stuff that is a little bit out of the money because based upon our analysis of the price move, we expect after a J-hook pattern breakout, wave 1, wave 3 is going to be up here. That's why we're buying the calls in the first place or buying a call spread in the first place. Armin, it's not a stop for the price of the options. It comes back to the same scenario. If this did a big sell signal and closed back down here telling you this isn't working, you close out the options. Remember, the options are just a method for buying the stock. Do you still make full profit if target is reached? No. What happens is, let's say, when is the ultimate date that you're going to maximize your returns? That's on expiration day. So let's say, for example, it closes right at 175 on expiration date. There's no premium left in this. There's no premium left in this. It'll be exactly at $10. Now, 2 days before option expiration date, let's say it's trading at 170. Oh, you could even be trading at 178, which means it's well above the 175. But where do you think the bigger premium is going to be in the option? In the one that's closer to the at the money area. So it might be that the 165s don't have as much premium. So on 2 days before expiration date, even though you're trading at 178, that option price, instead of being 10, might be 960. I'm just picking out a number because the premium on this option was trading a little bit higher on this. On the day of expiration, that's when you'll maximize profits. Okay, I'm going to read some. So the first number is the buy, and the second number is the sell, yes. Yep, so you're buying the 165s, and you're selling the 175s. Don, no, what will happen if the price goes to 175 in 3 days from now, 3 weeks or whatever, 4 weeks before expiration, it still may only be worth $7.40 because the 175 option prices have gone up faster because they're closer to the at the money, and the 160s being well in the money at that time won't move as fast. So the disadvantage of a spread is that it gets you in at a much cheaper price, but let's say that happens, that all of a sudden it skyrockets 40 points. So now the stock's trading at 200. The premium on the 175s may be higher, much higher percentage-wise than the 165s. So instead of it being $10, it may be $9.20 because this one is trading much higher as far as premium. You don't have to close it on expiration. Now, there'll be some times where it's trading at 178 and you're getting close to expiration, and instead of $10, they're trading at $10.70 just because of the different prices between the two. You could not just sell, no, Don, because once again, if it gets above 175 too quickly, the 175s are going to move up faster than the 165s, and so instead of it being $10, it might be still sitting at $5, $7, $8 because that price has moved up faster. Yes, so what you're looking for is to get above 175. If it does it too fast, you may have to sit with the option for a while, because the closer you get to expiration, the closer this will become a $10 difference. Now, this is all stuff we will go through on Saturday. What about assignment? No, you're not going to be assigned anything, because more than likely, if somebody is coming to assign you, the worst case scenario is if the brokerage firm says, oh, they got a spread on, you just get assigned, you call one set of stocks, you sell the other, and then they take care of the moving it over. Moreno, that's what we're doing. Now, this all sounds complicated, but as we go through it step by step, it'll become a lot easier to understand. So even if you're not familiar with options, just like if you're not familiar with candlesticks, when we do our candlestick training weekends, we start from A and go through Z, and that's the same thing we do with these options. So, and it's not like we're showing you the iron condor or the butterflies or all these sophisticated option strategies. If you learn the 4 simple strategies and apply them to the candlestick charts, it becomes very simple. You can sell one leg of the spread if you want to, but now you're just at an option trading risk. The whole point of putting on the spread was making the percent return based upon, so that's part of our other strategy, is maybe you put on a spread, and if you think it's going to go much higher than 175, you do buy just some calls outright. Do you close out the spread as you would a stock? Yes. Not because of the option prices, but if the price of the stock is turning against you, you're closing out the method that you bought the stock, which is the options. Yes, and if you close one side of the leg, you still have to have the money in the opposite, or to pay for that spread. All right, so yeah, this is why we're doing a full day training, because just this simple concept sounds difficult, but when you look at it piece by piece, it's very simple. You're not having to make a buy and a sell. They do that for you automatically. When I put in a spread and I want to buy the 175s and sell the 185s, they show me the price. Now, if that stock goes up, and it looks like it got to 182 and starting to turn around, maybe at that time in 2 weeks, this price is now $5.60. Well, I just put in the sell and say, all right, sell me at $5.60. You will review basic option pricing. Yes. Yes, we go through, again, very simple step-by-step process. When do you decide to use a $5 spread versus a $10 spread? Sometimes I can look at this and say, all right, now let's go back up here. Oh, that wasn't the one, this one. 170s and 180s, now they've got it at 420. And I don't want to pay any more than 2. So maybe I look at the 170s and 175, and that one's trading at $2. Well, maybe I'm better off buying 2 of those at $2 than buying one of these at $4.20. Or it may be that maybe I look now at 175, 180, and that might be trading at $1.80. Maybe that's more. So that's what we're going to walk through on not the Saturday, next Saturday. All the simple steps that you can take to see what's the best one to get into, not because of the price alone, but what's the math that makes this worthwhile. So if I'm looking at this, and here's the leverage that I'm looking for, I'm paying, now remember, if I was buying the 165s outright, I'd have to pay $14 for that. The spread is making it so I'm only paying $3.80. And if it moves in the right direction, that $3.80 now goes to $10. That has a lot less risk to it than buying the calls outright. Because what would happen if, let's say after a day or so it started turning around, these calls might drop down to 10, whereas my spread may only drop down to $3.50, a lot less percentage move. Can you talk about losses? The loss would be that if the stock turned around and was trading below 165, your $3.80 would become worthless. So that's your risk. That's your debit. That's what you're taking out of it. It's just like buying a $3 stock that could go to zero. This one could, and that's why you're buying the options, is to get the leverage. No, Chris, as I was saying, I don't know whether I scrolled down fast enough. If I bought this spread at $3, and in 4 days from now, or let's say 8 days from now, it's now trading at $5.40. When I hit on my account, just sell my vertical, and it's going to show me that I could get $5.40. I hit the sell, and then they work closing it out at $5.40. Yeah, that transaction is already being illustrated by what they could do to buy that spread for you and what they could do to sell that spread for you. So right now, ZM is almost $10 higher. Would you be better off getting a 170? Yes, you could do that. And this is what this was kind of doing at the end of the day. So buying just the call would be $1,400. Yep. How do you calculate your percent profit? Just by the numbers. If I've got $3.80 and it goes to $10, I've made $6.20, which means that's $163% profit above what I paid for it. So if you look at these numbers, the leverage, you got a lot less money involved. It only has to go to 175 to make this amount of profit. Whereas if I bought the calls outright, I've got more money exposed, and to make the same profit as going to 175, it has to go to 188. And there's my break evens. So essentially what it's telling us is that if I buy the bull spread to make 162% profit, it has to go right here or higher. To make that same percentage profit, it would have to go up to this level. Where on toss to see those spreads and make those trades? Frank, I think I could do that real quick for you. Oh boy, where was that slide? If you have this, if you go to whatever you're trading, you go to trades, hit all positions, you put in ZM, and it will show you the different execution dates and the different. So you can see this one is the May 15th expiration date, 22 days to expiration. Then you drop down and you see all the prices. Now, if I want to look at the spreads, you right-click on here, you'll get a blue line, and you'll get another drop-down box that says, trade, I forget what it is, but it will say vertical. When you click on vertical, it'll bring up this box that shows you, all right, you click on 165, 175, that's what the price is going to be. And if we need to, are you in the options or in the regular room tomorrow? If you're in the regular room tomorrow, bring up that you want to see how you get to the spreads. So if it goes below 165, you lose $380, yes. But the calculation or the analysis is, this is where we're anticipating it's going. So if I bought the, let's say if I bought the 170, 180, if it closed over the next, whatever it was, 3 weeks below 170, yeah, I've lost my money. But the calculation right now is the probabilities are that we're going higher. The default choices is, the top one is singles, I think, and then Paul, the one right below it is vertical. When you click on vertical, that's when this type of box will pop up and show you what the difference is. How do you determine whether it's expensive? If it's above $4 to make $10, that's too expensive for me. So now I calculate, I go to 170, 180. That's still a little bit too expensive. Now, could it get to 185? Yeah, now I go up to 175, 185 for $3. Now, if it's too expensive, now I can figure out whether I want to do a credit spread. So with Zoom trading at 167.70, I did this while I was moving up today. I could sell the 157.50s and buy the 150s. Remember, I'm not buying a put spread, I'm selling a put spread. So this is where it gets a little bit confusing when you're seeing two different, and this is why we're going to walk through it step by step. So if I sell the 157.50 and buy the 150s, yes, Steve. I put $2.45 in my pocket. That's what is called a credit spread. Or if I want to get a little bit more aggressive, I sell the 160s and buy the 150s. Now remember, I'm selling a put spread. That's the opposite of buying a put spread. If I buy a put spread, I'm anticipating prices going down. If I'm selling a put spread, I'm anticipating prices going up. So if I do 157.50 and buy back the 150s, I put $2.45 in my pocket. Now what does that mean to me as far as risk reward? Stock's trading at 167.70, and I think it's going up. And as long as it closes above 155.05, which is $2.45 below the 157.50, I'm going to break even or make money. Same scenario here. If I sell the 160s and buy back the 150s, I'm putting $3.45. What's my risk factor? $2.50 more. That if the stock came back down below 160, my break even now is 156.60. So anything that stays above that price, I'll make a profit. If it goes below that level, that I have to buy things back, and I lose my $3.45. Yes, so that's where the margin comes in. That they might, for $345, they might use $1,000 of margin for that purpose. That if it came back down through there, your maximum loss is going to be $10, the difference between these two prices, minus the $3.45 you put in your pocket, so you're going to lose whatever that is, $6.55. You are really, let's see, but you're really not using your target information here, correct? Just the knowledge and probability the prices aren't likely to fall back. Right. So this is part of that analysis of what is my risk reward. Now, if I'm finding that buying the call spread might be too expensive and it has to go up quite a bit to get there, let's just say I think it will hover right in here and not go anywhere. Well, I can put the credit spread on, and as long as it stays up above these prices, I put all that money, this amount or this amount, in my pocket. So the price doesn't even have to go up. As a matter of fact, the price could even come back down. I've got it the other way. The price could come back down to this level, and I think that was the 160 level, to still keep that full $3.45 in my pocket. And I wouldn't want to see it come back through this level, because that's where my maximum loss would be, which is the $10 minus the $3.45 that I put in my pocket. So, but probably I would have closed it out before it ever got back to that level. Do you leg out if the price crosses the first strike? No. If I'm buying that spread, I just want to keep it there because that percent return is still going to be pretty strong for me. How much are you spending to sell the put? You're not spending anything. You're selling the put and you're buying back the 150s. Now, the reason you're buying back the 150 is, let's say if something devastating happens, your maximum loss is going to be $7.50 minus the $2.45 you already put in your pocket. So you're going to be down $5 or so on that spread. What you're trying to protect yourself with this, buying this one, is let's say all of a sudden Zoom goes bankrupt. You don't want to be buying back the ones that you sold at in this trade for zero when you might have big, huge losses. This protects your loss So you're calculating, all right, is this stock price going to go up? Or I even think it stays above this level to make my maximum profit. So the credit spread, yes, so you're selling the 157.50s, putting that money in your pocket, and then you're buying the 150 puts, paying that out, and the difference is that $2.45. Now you're looking for that stock to just stay above this level for the next X number of weeks or how long your expiration is to maximize your profit. Do you see the overall market going to sell off? We'll get to the live charts in a minute. Here, let's see. Okay, so this is why it's kind of, I want to just illustrate. Here is so if you take out everything else, a bull spread, much less money, much lower price, and a lot lower break even. Much better than just buying calls outright. A credit spread is a lot more less risky if you think the stock price is going in an opposite direction of the credit spread. So it might not be as profitable, but the probabilities are much greater based upon our analysis of which direction we think the stock price is going to go. So this is what we're trying to show people is this is not a difficult process. It's not even a difficult calculation. Once you get this, and now you can't really assess what the overall market might be doing, you've got a few different strategies that you dramatically reduce your risk. If you are bullish, how do you decide on a debit call spread versus selling a put spread? Exactly what I was just saying. Let's say we think the markets are going up, but we're not sure. That maybe this is hovering right in here. So maybe a put spread, selling a put spread is better than going after a call spread where we anticipate the price is going to move up much stronger. I'm an option trader, and I suggest to take Steve's. Oh, okay. Yes, and once it sinks in, thank you, Eric. Once it sinks in, it's not difficult. Once you understand and it sinks into your head that buying or selling a put spread, which is bullish, might be more economical or more profitable risk-wise than selling or buying a call spread. So again, we got the advantage of knowing the direction of a move, the timeliness of a move, and the magnitude of a move. And here's the 4 simple strategies. The reason I use these strategies is because I don't want to be up hours into the night trying to figure out my option strategy. I want to take a look at these, and then if it takes me 10, 15 minutes to figure out what my best charts look like, then I want to take another 7, 8 minutes to figure out which strategy to put on. What's your max risk percentage on a credit spread? Nothing, Jake. I'm not factoring the risk. I've already calculated my risk. I'm not going to spend any more than $2 to make $5. I've already calculated whether the price of the underlying stock has the capability of going up through that the top of that spread. So it's not a percentage risk. It's what's the calculation of, well, yeah, number 4 is a combination of these, which is viable. So, yeah, there might be a time where we might buy some bull spreads way out of the money and buy some calls at the money. And that's what we'll go through is what makes the most sense. When bullish, selling put spread, high probability but lower profit. There you go. Thank you, DS. That's exactly right. So you want a $10 difference between, no, I'm going to look at which ones make the sense. Sometimes it's a $5 spread. Sometimes it's a $20 spread, depending on which stock. I would say the majority of them $5 because the prices of some of the lower price stocks are much don't move around as much. I'm talking about the credit spread. Where can you lose 3 or 4 times of your credit? You can't. You've already figured in that if the worst case scenario on buying the 157 or selling the 157 is buying the 150, my maximum loss on this is $7.50, the difference between the two. But I've already put $2.45 in my pocket. So my maximum loss is $5.05. So you can't lose any more than that amount, the difference between the two prices. Here I might lose $10, but I put $3.45 in my pocket, so my maximum loss is going to be $6.55. Yeah, you've already, I don't know whether you can do it in a, Kenneth, I'll have to go back up. I can't see the time frames. I'm going up, 8:45. All right, everybody hang on for a second. We'll get to live charts. On April 15th, I put, I put on a July 17 TOK close. I had $4.70 at risk. Half the stock had moved from under 160 to over 180. Then I closed the position on April 20. I made 80 cents for a more than 20. Too much, too fast. Yes. This is why when we did the first charts, I don't know whether I've got it on here, if you're going to do a spread, you probably don't want to be any more than 2 or 3 weeks out in front of expiration date. And if I'm doing a credit spread, I want it to be even shorter. Because what you're doing is you're selling the premium that somebody is willing to pay on a put. So you're selling them that put that they're paying a premium for. So if it keeps moving in the right direction, your intrinsic value is going down and the premium is going down. So when you're buying a call, it has to go up through that price, your strike price, and you're even paying a premium on top of that. So if that price doesn't move after you bought that call, you're losing the value of the intrinsic value and the premium you paid, you're losing. So that's exactly what you're doing when you're selling a put spread. You're taking somebody's premium they're willing to pay plus the intrinsic value and putting it in your pocket. Dan, it's not taking profits on your spread. It's taking profits when you see the price of the underlying stock, that if you were getting ready to sell it, then you're getting ready to sell your spreads. You could always close your position at any time. That's right. That's true too. So that's your risk-reward factor. If you're buying a debit spread, you're putting $3.80 out of pocket to maybe make $6.20. But your better risk-reward, now I guess your better risk factor is when you're selling your credit spread with a $750 difference. Yes, you're tying up that amount of capital, but the probabilities of that $2.45 is probably much higher because it doesn't have to move in price. It doesn't even have to move from where you did it, and it could even go down from where you bought it and still make your $2.45. You may lose more if closing a credit spread before the expiration in a losing trade. You may lose more if closing a credit spread before the expiration. RP, no, that's not true. Is there a minimum of how much volume a stock must have to do a call or put spread? David, that's just general option analysis. It's much harder to do. I usually look for stocks that are trading at least 1 million shares. There's some good stocks that trade 500, 600,000 shares a day, but that's getting a little bit dicey for getting in and out of the calls or puts. So if you're looking at a stock that does 800,000 shares a day, it trades at $84, and you see what the price is that they can do a spread, you put it in. Let's say the price is $3 that they say they can do it for. Well, if you put it in and they haven't done it in 10 minutes, that means they're having a hard time getting it done. So that's why I usually try to stay with the much higher volume stock prices. Okay, let's how do you determine strikes for GW? I don't know what a CCS versus PCS. I think that if the price is moving towards your sold strike, you can lose money if you buy a spread back. It will cost you more to buy it back than you took. Yeah, that's true. If it goes down below, again, let me illustrate this. That if you did this credit spread, that if it came back down to this price, that's break even. If it comes down to this price and you haven't sold it out, yeah, you're going to lose money on the spread, but your maximum loss is going to be, if you did the $10 spread, your maximum loss is going to be $6.55 because you already put $3.45 in your pocket. All right, so this is exactly why we're doing the full day training, because we're going to walk through each strategy till you understand it. And that may mean an hour on each strategy. Then we're going to go through and take a look at a stock chart and say, all right, what are the different strategies? And we're also going to be looking at how much time do you have for that. If we're looking at the market about ready to top out, you might not be doing a very long-term bullish strategy. All right, Victor, let me get to the, yeah, so anyways, there's, let's put it this way. You're going to get much more than it's May 2nd. We'll probably start at, what time would you start the last one? At 10? Start at 10, anticipate it going to 1, but expect it to go to maybe 3 or 4. And I'll sit there until everybody understands it. It's not like a lot of courses. I've had so many people appreciate what we do in our options training, because I've had so many people say they took an options training course and they understood less when they got done with it than when they went in. I want to keep everything as simple as possible. Again, for my own sake, I don't want to be spending 45 minutes, an hour and a half each night figuring out option strategies. I want to spend 6, 7, 8 minutes after I've found the trade that I want to do to figure out which is the best option strategy. Okay, so this is it right here. And again, I will make sure you learn it, and you're going to get a lot more information than you expect. So that's kind of the modus operandi I try to work off of. All right, so let's go to some live charts. Oh, look how close that was. All right, so there was our Zoom analysis today. Why would a spread be good for something like Apple? Because we think it could be breaking out, but we don't know yet. So once it gets moving, maybe a spread is much better. Kirk, no, there's going to be some specials for the members. Yes, that's the, we're going to be adding specials to it. So we're trying to keep prices down as low as possible for everybody, but we're going to give the members some extra specials. Yes, if we have to, Robert, I'll go through the whole process of how you do scans and then how you set up for the best option trades. Okay, so what am I looking at here? The Dow. So this is the doubtful part. We had a good bullish flutter kicker. Again, notice how it closed down here. They gapped up yesterday above the open and then traded positive today. That was good. That was telling us we were still in a strong uptrend. But now we close back as a doji. That gives us a different perspective. That tells us it's going to move in the direction of how they open. If they open lower, what's it telling us? So we're getting soggy up here. Now that isn't a major concern as long as it's not a hard selling occurring. Now, as far as the NASDAQ, even though it traded back indecisively on the day, it's still above the 3T line, let alone the T line and the 200 and the 50. So we have to assume that we're still in an uptrend, and it unfortunately may not be a strong uptrend. It may be sideways. However, when we start looking at some of the other indexes or commodities like crude oil, look what we always kind of look for. Where do most people sell? They panic sell at the bottom. When do you grab for the fallen knife? Look at our Doji Harami being confirmed. Where do you think the first target was on this up here to the T line? Then you see what happens there. Which one is it? Hogs. Look what was happening in the hog chart. It was going down the limit for quite a few days. It bounced back up, came right back down to the bottom. Then look at your kind of little bullish flutter kicker. Then your doji sandwich. I mean, this just was telling you, these are the signals that told you that things are starting to move back up. And gold still heading up, which makes our recommendation on AU still good. Ego is still good. There's a few other golds. GFI. So we've got, again, a double confirmation that if we can analyze what the underlying commodity is doing, we can pretty much have a better probability of which way the stocks in that sector are going to go. So look at SA. It did gap up through doing our bobble breakout. So how do you buy this one? Simple. If it opens positive tomorrow, you start buying. I get why crude is way low, but why would hogs go down? People are still eating. Jake, I think because they haven't been able to get them, I think one of the major slaughterhouses, was it, I forget which company it was, stopped or closed down one of their slaughterhouses. So that means they can't get the hogs to get hogs to the market, which means whatever hogs they do have, it's Smithfield, yep. So that means they can't get hogs to the market. So that whatever hogs are there, people are paying up for it. So, anyways, that's yeah, cattle. I think cattle. No, you can see what cattle has been doing. It's been flat. Now there was a time where it was dropping down the limit, and then it popped up the limit. Then it's dropped down again, but now you can see what it's doing. It's in this wedge, so it's something you don't trade. All right, let's take a look at what stocks we did at AU. The oil stocks are coming up, so you can be still buying USAC on positive trading tomorrow. You can see what's happening with the price patterns in Halliburton and Enron, oil and gas, Schlumberger. They're all producing these patterns that we recognize, a fry pan bottom. China, yeah, China's had problems with the African swine flu for a while. That's true too. If they're killing off and they're dumping milk, I mean they're just not able to get their products to market right now. Now we recommended Nuva because you can see the T-line crunch, the doji. This one can still be bought because if it trades positive from here, you've got a good breakout situation. We've been making very good money on INO. It backed off a little bit today, but it's trading positive again. So you can see where this one broke out, right there. Slow curve breakout. And Codex, kind of the same scenario. It broke out nicely through this wedge with a double doji setup, and I think it was trading up a little bit after hours. That's true too. There's the demand for a lot of the foods are lower just because people don't buy it as heftily as they do if they went to a restaurant. NNA, you stay long. Clovis. You can see what it's doing. Now I'd have a safety stop down here, below the lows. I'd want to see the J-hook pattern in progress. What is the significance of the T-line? The T-line is your most significant factor when you're using candlestick signals. It's the 8 exponential moving average. We call it the T-line because we call it the trigger line. So here's the most important thing about the T-line in candlesticks. Candlesticks are the graphic depiction of everybody buying and selling, or basically telling you what's going on in investor sentiment. The T-line acts like a natural Fibonacci characteristic, a natural support and resistance level of human nature. So there's a very simple combination. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. That's just a high probability setup. Hold on to your individual stocks until I tell Jim to do the double line. On Clovis, let me finish Thompson's question. So you put the T-line on your chart, and you can stay long as it stays above the T-line, with the caveat that the further away you move from the T-line, as we saw, I like to use this illustration. Look at what was happening in Tesla a while back. Uptrend, waffling, but you could stay long as it stayed above the T-line. And then the most basic nature of human nature is, where do most people buy? They buy exuberantly at the top. How do we recognize that? You start seeing gap ups, start seeing big price moves, and you start moving away from the T-line. So we had a very simple process. If you see a move like this, how do you know when to get out of it well before it comes back to the T-line? Well, we already know you're too far from the T-line, so when it's trading up here, you flip to your 10-minute chart, and when you see a sell signal and a close back below the 10-minute T-line, you take profits. You're way ahead of everybody else. That's the T-line. So the other moving averages are the 200, the 50, which every money manager has on their charts, every money manager around the world. The light green line is the 3T line. The further away you move from the T-line, the more relevant it becomes. And then the 34 works pretty good. That's a 34 EMA. That's all you really need on your charts. And I could probably take this one off, take this one off, take this one off, and just use the T-line and make very good money. These just add confirmation as to when we can see when everybody else is buying or selling. APLS did some profit taking today. Shooting star. So if this opened lower, a sell signal in the overbought area, where do you think the next price move will be? Back to the T-line. Is there a possibility of discounting the scanning bundle for members? RP, that's not in our hands because that was developed. We paid the people at Thinkorswim to do that up for us. But let me put it this way. It's not so expensive that once you buy it and put it on your system, that it's not going to make you lots of money afterwards. So you have some things are out of our hands. All right. I don't know whether I bought some of this. I think I did. Look what this one is doing. What is our classic pattern? A fry pan bottom. What do we expect coming out of a fry pan bottom? A strong price move. What happens on the pullback? There's your J-hook pattern, or what you call the classic pattern. What's a prerequisite for a J-hook pattern? A strong price move. What's our next prospect? Wave 1, wave 3. Toss developed the put our formulas on and made it into the package. So we've got those costs, unfortunately. OSUR, we're still long this because there's your J-hook pattern. Wave 1, wave 3 in progress. Now what do we watch up here? You're starting to move a little bit away from the T-line. So where's the first logical safety stop? Right here. Logic says if they come down through that level, it's time to take profits. Now I think I've got Venda on here somewhere, and I'll just type it in. You just stay long. Notice you're still above the 3T line. Wave 1, wave 2, look at the bullish flutter kicker signal. Starting wave 3, where do you think wave 3 should take you? Probably up here to the 200-day moving average. Cry, trying to get up through the 50. Stay long on this slow curve breakout. AAOI, that is the bobble breakout. Where do you think wave 3 is taking you? Up here to the 200-day moving average. What is the difference between what we have in the document in the folder for? That's your basic signals. Then they've done the formulas for the best friend, the left-right combo. Oh, there's a bunch more. So they're the more advanced signals and patterns. We did put a option strategy out in the options room. Look what happened when it broke out. Crowd strike. You stay long on this one. Zoom, we have a bunch of option strategies going right now. So things like Amazon, you can see when it broke out and what it's doing. There's the J-hook pattern. And here's the thing that is very relevant. Notice how Amazon came right smack dab to the T-line. Now, the relevant factor is nobody has the T-line on their charts. So it's not like it came back and hit a target that everybody was watching, because nobody has this on their charts. It came back to a natural support level of human nature, which we can identify. Is there a rule of thumb to use for how far? No, just visual. You can see when something starts moving too far away based upon what it normally does. And then you're going to see some profit taking. Yeah, Mike, you're chopped liver. When I say nobody, there's probably about 2 or 3 chat room groups that have been guest speakers, or I've been guest speakers on their sessions that use the T-line. But statistically, nobody has it. How do we get the T-line if nobody has it on their charts? It's the 8 exponential moving average. You put it on just like you would the 50-day moving average. Keep your individual stocks until I get finished here. I've got a few more, and then I'll do some. Netflix came right back to the T-line. You can buy this one on positive trading tomorrow because of the inverted hammer type signal. NVIDIA, you're in an uptrend as long as you're above the T-line. And that's about it. And then Tesla, also, if this starts trading positive, what do you got going on? Your J-hook pattern. So here's some good looking charts that will probably be on the recommended list tonight. ICAD. Look at your slow curve breakout, bobble breakout. Where do you think your next target's going to be? Probably up in this range. What happens if this opens positive tomorrow after breaking out? There's your doji sandwich confirmation. And look at your T-line crunch breakout. You can buy this one on positive trading. Wave 1, wave 2, T-line crunch going into wave 3. Where if you're buying ICAD, whoops, apparently I didn't hit this. Where would I not want to see that? If I was buying this on positive trading tomorrow, where wouldn't I want to see this close? If this is the candle that told me they're breaking out, probably wouldn't want to see it close back below the halfway point of the candle body, not just the shadows, just the body. Why do I have that on here? I don't know why that wasn't on here. There's your J-hook pattern on PSTI. Look at your slow curve breakout. This is what we expect from a slow curve, is that big price move. So a very simple chart pattern. If you're buying it, if it closes back here, you close it out. It didn't work. But the probabilities of it working is that when it does work, the magnitude of the move is very extensive. Jake, why would you say that? This tells you there was strong buying. Doesn't mean that they're going to bring it back. So just because something breaks out doesn't mean that if wave 1, wave 2, wave 3, maybe it will come back, but it might be a month later. Let's see, we did the oils, let's see, there's a couple good good charts of the oils. There's a doji sandwich fry pan bottom breakout. Where do you think the next target is? Probably up here at the 200. There's your kind of a little mini doji sandwich, bullish flutter type signal. You can buy this one on Positive Trading. Is there a link for a 30-day free trial? Then join, yes. Becky, do you have the link for the 30-day free trial? Let me see. Hold on. Becky, if you could find that. If not, I'll find it when we get done here. Beyond Meat. You can see how this broke out. There's your little slow curve. There's your next likely target. And so when we can recognize which signals or patterns are ready to set up, pays, you can see the bobble breakout with a slow curve. So you can definitely be buying this one on Positive Trading tomorrow. And things like Nautilus, that wasn't it. Yes, it was. How come that's not working? NLTS? I don't know why. It was acting better than Peloton. Peloton, as you can see, look how far away you moved from the T-line. If you were up here and you were long, what was your first alert? The fact that you were that far away from the T-line, you're in the overbought condition, that's when you would have flipped to your 10-minute chart. Oh, is it just NLS? All right, NLS. Yep. So Nautilus is a J-hook pattern. And, the Shaw. Fate, setting up for a J-hook pattern on Positive Trading. Okay. Let me do this real quick. So the first thing I usually ask, is there any general questions on candlestick analysis? There it is. All right, so what happens as a free member or a trial member, I put out 2 or 3 stock picks a day in a video format at night so that if you're in the trial period, you get to see those. Monday night, we have the same type of session where we kind of concentrate a little bit more on our existing positions and why they were bought and whether you should be holding them, what other stocks might be working well. The chat room is open all day long. I'll come in 2 or 3 times a day into the main room, come in a couple times a day into the options room, and the options room is also the futures room. So if you're trading futures, that's where you ask questions about which commodities to trade. I was trading. Humbug. How come I'm not hitting anything right here? I was trading, look at the hammer signal on soybeans, and it's still trading higher. And look where it occurred, right here where the Morningstar signal occurred. What do you use simple moving average? For the 50 and the 200, the 34 is the EMA. Now 34 is a relatively good, so I put these as major moving averages and kind of a secondary moving average, but this is your most important one, is the T-line. Once you learn what the signals do in conjunction with the T-line, now you start mastering your own trading. You don't have to be worrying about what everybody else is doing or saying. DJ, I don't think we have anything for Trading View. I haven't heard from them. Okay, I guess with that, Jim, go ahead and do the double line. And in 4.6 seconds, do the next double line. Oops, yeah, I got to stop the scrolling. All right. Still can't stop the scrolling. Okay, into it. You can get ready to buy this one. I wouldn't, if you're long, you stay long. If you're looking to go long, I'd be more apt to buy it up through the 200. Guild got hit today, or did they? Yeah, they got hit because there was a report that their vaccine or whatever wasn't working as well as expected. Whiting has popped up. I think they declared bankruptcy, but now they're getting some funding. So that's gone up a good percentage from 30 cents to $1.60. Obviously, that's about a $500-600 upside. You could still be buying it. Oh boy, I wouldn't want to see it close back below the halfway point of candle. This is Zoom, because that would put you back into the trading range. This candle told you they broke out into new territory. Now, if the bears knock it back down, telling you they're not breaking out into new territory. EWH, the Hong Kong, nothing there to get excited about until they get up through the 50. Abbott, you stay long on this, but it needs to stay above the T-line. And SIG, nothing there. I wouldn't be long or short. So it's one of the trucking firms, yes. That one you can get ready to buy, especially if it breaks out through this level. So you're stuck in a sideways trading range, but look at your little bullish flutter kicker. That's a strong reversal. There's another bobble breakout. You get ready to buy this one on positive trading. Again, a little bullish flutter kicker. That's added evidence that you're probably going to get some more upside, especially if they open up positive. Good charts. Oh, I don't know, what is this, the oh, that's not coming up here, Gary. You can get ready to buy this one also. Your little doji gap up. Look for it to come back up probably to the 50, which would be the top of this channel. So you can buy this one on positive trading. Don't let it close back below the T-line. Facebook, there's your kicker type signal that broke out through the 50. A positive open would give you a kicker signal plus a bullish doji sandwich, making the 200 your likely target. Apple needs to show some strength tomorrow, and if it opens lower, you stay away from it. The stocks, slow uptrend. It's still kind of iffy, kind of waffling in here. Nokia, another one that has to open positive. If it opens lower, you want to be out of it. If it opens positive, you've got that bobble breakout. And Shopify, you just stay long. Look at your big bearish engulfing signal that didn't confirm, and look where you're trading. Look how it's used the 3T line as support, telling you that you've got more, or yeah, you still got bullish in control. Watt, there's what you call your message, and now it's telling you the selling has stopped. You can start buying this one. Look at your fry pan bottom breakout. Now you want to buy on strength. And INSG was working well early today, came back as a shooting star, which means it definitely needs to open positive tomorrow. If it opens lower, you pretty much got a double top, and it's probably coming back down to test the T-line. And PBYI, another one that you want to see open positive. If it opens lower, it's probably coming back down to test the T-line as well as the 50. Pepsi, right now you could probably be going short if it's traded weak on weakness. I wouldn't be long on this one. And KBM, Kimberly-Clark, you stay long as this stays up above the T-line. But you're getting a little bit toppy up here, so make sure you use the T-line as your stop. Procter & Gamble, usually not a very exciting stock to trade. You should be out of it if it opens lower. It has to open positive and trade positive to stay in it. Amazon, you want to see this one open positive. If it opens lower, it's still consolidating, probably coming back to the T-line again. And USAC, we did early. You want to see this open positive. If it opens lower, it's coming back to the T-line. You close it out and wait to see what it does at the T-line. Lamb needs to open positive also. Why do these get so small? It's not a great chart. If it opened lower tomorrow, I'd close it out because it's not going anywhere. It needs to get some strength and get back up above the T-line. Coles, if you're short, darn, I don't know why these charts keep kicking back. If you're short, you stay short. If you're short, don't let it close above the T-line. Schlumberger, we did. They're all doing this type of pattern. You can be buying this one on strength. Roku, you can see the fry pan bottom breakout. There's a doji right on the 200. Remember the doji rule. It's going to move in the direction of how they open it after a doji. So see how they open this one tomorrow, which would probably also be a function of how they open the market tomorrow. The Qs just kind of lollygagging in here. Just they need to stay up above the T-line, and AMD needs to stay up above the T-line. Las Vegas Sands, kind of a little scoop type bottom right here at the bottom of this wedge. You can be buying this one, but you want to see it break out through the 34, which then make the 50 your next target. So you need to see strength on this one. If it opens lower, you're still caught in this wedge sideways. McDonald's having trouble right here at the 50. You stay long as it stays above the T-line. We did whiting, gold, forming a J-hook pattern, yes. And the AXSM, you stay long on this if it opens positive. There's your bobble breakout. Is a reverse hammer today, a berry signal. It's called a shooting star. Yes. So if it opens lower, you close it out. It means they're failing at the 50. It has to open positive to stay in it. SPX. That's no, that's not what we're looking for. I'm looking for the SPY's kind of stuck right here at the 50. Oasis, nice little breakout. Didn't realize it was down that low. You can get ready to buy this. There's your best friend breakout. TSLR. PC. Another one that is in a slow move to the upside. You probably want to see this break out through the 34. There's a gap to fill right here, which would take you up to the 50. And space, at best you want to be short. Definitely don't want to be long. When you close below the T line, you should have been out of any longs. Now you can be going short on weakness. INSG has to open positive. Tesla also needs to open positive. You don't want to see this trade back below the T line. Silver, well, we don't need to do silver here. Silver is coming back up. And silver price, let's see, SIAK. Silver kind of flat. Gold is more positive. Whoops. Well, we don't need to do, oh man. USO is looking for a bottom down here. But I think they're going to reverse split this one. Again, crude oil has done a bearish harami, starting to trade back up. So it's back up another 80 cents after hours. Tonight, no, 67 cents. I can even see now I've got my good glasses on. So it looks like crude oil has bottomed out. Nvidia, slow uptrend as long as it stays above the T line. Walmart, getting a little bit soggy up here. If it starts trading down below the T line, you want to be out of it. NEP was a good chart today. Good breakout. You can see the best friend, doji gap up. Wave 1, wave 3 should take you up to the 200. APT showed a little bit of strength today. You can still buy this if it breaks up through this level. Apple Apple needs to open positive tomorrow. Caterpillar, Caterpillar, probably wouldn't be long or short. There's no direction to it right now. Where did I go? Did I skip a bunch? I skipped one, MGPI. This one you get ready to buy. There's your long-legged doji. It's going to move in the direction how they open this one tomorrow. SDC, that one ran out of steam. If it opens lower, you close it out. It's coming back to the T-line, but it's still in the fry pan. You can buy it if it comes back up through today's open. And PRVD, that's not working. MMPL, that's a nice fry pan bottom. Make sure your volume's good. I'd be a buyer of this one on strength tomorrow. LH, you stay long as this stays above the T-line. TDOC, you stay long on this one. YY was having trouble staying up above the T-line. You can still buy this one. If I was buying, I'd want to see it come up through these this little top right there. I think we did AMD, right? Yeah, this needs to open positive tomorrow. STWD, nothing. No direction. It would not be long or short. SBAC. Want to see this one open positive to keep the J-hook type pattern in progress. The SOX, kind of flat, needs to stay above the T-line. And Labu, That move's been acting pretty good. You're still in this uptrend. You stay long as this stays above the T line, which will be up above the 50 tomorrow. This one has got a kind of T-line crunch at the 34. Don't let it close below the T-line. It needs to pop to the upside soon. And IBB, another one of the biotechs, stay with this as long as it stays above the T-line. With a full-time job, can you still get trades in the evening after 3? Yes, I put out the stock picks usually late at night, or they'll be in by before the market opens, so you can look at them then. And then you just have to figure out the best strategy for setting stops or buy stops and then stops. So it depends on how much time you have to look at them during the day. VAR, nothing. Sideways, wouldn't be long or short. Sting, you stay long on this one. I'll probably use today's low as a safety stop. Shopify, stay long. I'd also use probably today's low as a stop. Not really. It's not big enough, and look at it closed right on the 3T line. So you stay long on this as long as this is why you use a combination of the sell signal and a close below the T line, just for this factor right here. You'll see sell signals, but they're not confirmed until they close below the T line. Humana, get ready to buy this one on positive trading. It needs to stay above the T line. Sienna, flat. I wouldn't be long or short on this one right now. ENIA was one of the utilities that's been drifting, but notice the drifting. Not very decisive, and it's right here on the 50. That means you buy it on the next strong signal. Boeing, no, wouldn't be long or short. You can see the wedge formation. So you need to see it break out one way or the other from that. Right now, it wouldn't be long or short. And JD.com also needs to open positive, giving you kind of a bullish sandwich, a bullish doji sandwich, and a J-hook pattern setup. Jake, I haven't seen shorts, so I had some the other day. Let me think of what they were. Well, there were things like Las Vegas Sands, but it picked up a little bit of strength. And I haven't checked on shorts yet. I just haven't had time. Do you start a trade before it gets to the T-line? Yes, if it's too far away from the T-line, remember the number one criteria is the signal itself. So if I saw a signal like this and I saw it trading positive, I'd probably start buying it. That one's probably too close. But if something moves too far away, remember, there's a bullish flutter kicker signal. That one wasn't a good example. But yes, remember, the T-line is just a secondary confirmation. The signal is your number one priority. Any of us getting in early versus waiting for perfection? As far as getting into a trade early, a lot of people ask, well, how do you know when the signal, how do you anticipate the signal? You don't. The signal is what you're looking for. You're not trying to buy at the absolute bottom or sell at the absolute top. You're trying to make the fat part. This is not a good chart to illustrate. But you're trying to get in here so that you're in early, because it does two things for you. You want to buy on bullish confirmation to prove the probabilities are in your favor. And then you want to get out when the other elements start changing the probabilities, like in the overbought condition, starting to move too far away from the T line, starting to see little sell signals. Uber, T-line crunch, you can buy this at $29.70 knowing that it came up through the 50. It could be a shooting star. It's a shooting star signal. Stochastic's just heading down, but it's telling you there's weakness. But if it opened lower, yeah, you could probably start. It shouldn't be in the trade anymore, or you could think about going short. And SU, another one of the oils that you could be buying on strength. What is the 3T line? That's the little green one right here that kind of confirms when you're too far away from the T line that you're probably heading back to the T line, or if you start seeing selling, it acts like another little added confirmation when it comes down through the T line that it's, along with the signal, it's adding confirmation that the sellers are in control. MTSI, that's a good good J-hook pattern. Notice when it came up through the 50, where did it come back? Right to the 50. And when everybody saw it was acting as support, what do you think they're thinking? If it is acting as support, let's buy it. And Procter & Gamble, I wouldn't be long and I wouldn't be short. It's just not a tradable stock. Vodafone looks like a dumpling top, which means you want to be short as long as it stays below the T line. Because a dumpling top is the opposite of your fry pan bottom. You could get a big push to the downside. Eric, I think when you set up, they ask you whether you want to do the chat in a separate, in one screen or two screens. They're running out of carbon dioxide. Oh, man. I thought that was what the, that's, no, can't remember. We're still on Vodafone. What is it? BBCP. That's a good little breakout. Make sure your volume is good. .3G kind of went quiet. Wouldn't be long or short right now. Again, anytime you see a good buy signal, you close it out when it closes back below the T line. I think we did YY has to open positive. Did this one. You can buy this one, but if it opens lower or trades lower tomorrow, it's coming back to test the T line. Remember, your fry pan bottom is still in existence as long as it doesn't close below the T line. Coop didn't close below the T line. However, it has to open positive. If it opens lower, close it out. It means the bulls didn't win. MasterCard, not anything exciting on that one. I'd be someplace else. Because it's not changing. What's your trend? Your trend is up. That's just a wee little trading range, and it's still closed above the 3T line. So you've got a little bearish engulfing signal. You had a bearish engulfing signal, but they didn't close it below the T line. You've had a bullish flutter kicker. So that tells you the trend's still in progress. So you can watch it, but until you see a candlestick sell signal and a close below the T line, you got to assume wave one, wave two. Now you got a bullish flutter kicker pushing into wave three. So remember, a signal Still needs confirmation. Yeah, I'll try to find a, well, this was kind of a bobble pattern when it failed at the 50 and then came back up through the 50. New relic. It has to open positive to give you a bobble breakout again. Kind of a little bullish flutter kicker signal also. And GMed. Another one that's supporting at the 50. You can buy this one on strength. You need to see it get through here to give you kind of a J-hook pattern. So if you're long, you stay long, but it needs to break out through that level. And Microsoft needs to stay above the T-line to stay in it, even as a trade. Starbucks needs to open positive and trade positive, also needs to stay above the T-line. Cindy, I don't know when they're planning to reverse that one. There's no, Pat, that's right. There is absolutely no place to put oil right now. UVXY. If you're long, it has to open positive tomorrow. Goldman. Whoops, General Dynamics. That's a dumpling top. And Goldman Sachs. Dang, hitting too many. Goldman Sachs, I wouldn't be long or short. Nothing there to tell you which direction it's going. The 20-year notes. Flat. Slow uptrend, but not anything that looks tradable at this point. Just basically tells us our interest rates aren't going anywhere. An MR, you stay long on this. Look at your J-hook pattern and your doji best friend gap up to confirm it. You stay long until you see a sell signal. We did APT. You can buy this one on positive trading. So one of the tankers. You can buy this one, the fry pan bottom. If I was buying tomorrow, I'd buy if it comes back up through today's open. Steve, are we still asking the same question? No, we're not concerned. It's not a big enough signal and it hasn't confirmed below the T-line yet. ATKR, nothing. Wouldn't be long or short. TMT. Edward, that one's not coming up. And PBY, Pitney Bowes. Slow uptrend. Probably has good volume. Oh, 3 white soldiers. It did have 3 white soldiers. Yes. So, but it's still not a very dynamic stock. You can buy it if you want. It's just not going to be a huge percentage mover for what it looks like. NMIH. Still caught in this wedge. I'd want to see it break out through this little resistance level. SDC, even though it backed off today, it's still in the fry pan bottom. It's still above the 3T line. It's not a sell signal. If you're going to be a buyer, I'd still use today's open as a buy entry. ExxonMobil needs to get up through the 50, trying to do the little J-hook pattern. And Bank of America, usually not a very big trader. I wouldn't be long or short that one right now. The dynamic power pack is the scan, Robert. You just, when you get it, you're going to put the, you're going to have the download formulas. You just follow the steps and it downloads everything into your Thinkorswim. No, she just kind of looks at them. They look at her. They all go their own ways. It was the bear. We had a bear out front a couple of nights ago, which I went out to find the cat, and he or she was out there, but he was more of afraid of me than I was of him. What did I just do? Microsoft has to open positive. Is this new beverage? Nothing. Wouldn't be long or short. And Schlumberger is still in this fry pan bottom setup. Is that formula not in our little file down in the very right-hand corner? The kicker signal? If not, if you're in the room tomorrow, just ask for it, and I think people can copy and paste it for you. EMR, you stay long. CDR. And nothing yet, still kind of a wedge type formation. Nordic, you stay long. I would probably use today's low as a stop, because you can see that they open it and trade lower, open it, trade lower. That tells you that it's running out of steam. The 20-year bulls, yeah, you just stay long on this if you like trading it. It's not a very wild trader. What's the difference for the trade if other moving averages are above or below the T-line? Nothing. We're not trading the moving averages. We're trading the symbols or the signals. The moving averages are just indicators that everybody else is watching. So it doesn't matter whether some people say, oh, I don't buy because unless it's above the 50. It doesn't matter. The signals are what we're buying. Everything else is just what everybody else is watching. Can you explain why some of the oil service pipeline stocks are doing well? Jake, no, I can't. But I don't have to. Somebody that's probably a lot smarter than us is buying. They might be thinking 2 steps ahead of us. We don't have to try to figure that out. All we have to do is figure out that they're buying. That's the whole point of seeing the visuals of candlesticks, is telling you what's going on. We might not know why. We just know that it's happening. Oh, yeah, but Bank of America, Frank, is just such a slow trader. I just have a hard time even trying to figure out what that one's doing. Chaparral Energy, you can get ready to buy this one if you like buying those. That's true too, Dean. Yep. They are buyout candidates. Yes, it makes sense that if you can buy stocks of oil companies that have big reserves, you may be paying $4 a barrel versus going out and trying to drill for it when you break even to somewhere around $30 a barrel. Williams-Sonoma, that's a nice little breakout. You can be buying this one. People must be buying pots and pans now that they're sitting home. And Kroger, nothing wild there. I mean, you can buy this one. Your percentage move is going to be very, very slow. Best Buy, Kind of a bobble breakout, yes. And your T-line crunch. The T-line crunching it up through the resistance level. And Dr. Reddy's Laboratories. All you can do here is stay long, as long as it stays above the T-line. Stay long on Sprouts. Get ready to buy Kraft Heinz. Always like to tell people the trivia because Heinz is right here in Pittsburgh. Why they have 57 Heinz or 57 on their label. That one you get ready to buy if it opens positive. And Bed Bath & Beyond. Nothing there yet at all. Marna did some backing and filling today. So there's a good possibility they could be taking it back down to the T-line. Can I buy a PT debit spread? Yes. Whatever, yeah, nobody's. That's why you want to learn to see what spread is the best risk reward. Lake, I wouldn't be long or short. Nothing there. Most people think it's because they had 57 different products, Eric. But the president, I forget what his name is, was riding on a train and he went by a building or a sign that had 57 on it and he liked it and they decided to use that for their number. Rite Aid, I wouldn't be long or short, no direction. You get a lot of useful trivia information in this room. So everybody thinks they got 57 different products. When they use 57 for their number, I think they had over like 300 products already. MRSN, you can buy this one, especially if it came back up through today's high, giving you the J-hook pattern. No fresh jokes. I just, yeah, I've got them. I usually tell a joke because I hear a word or a topic. I've got a joke for it. I just getting too old to think of new jokes anymore. How does the options room work? Just like the regular room, this room. We got now about 40 people in there. We got some very good option traders, so when they'll put out a recommendation and they'll say what they're buying, whether they're buying a spread or why they're buying a spread. Thank you, Ahmed. Yep. Oh, I didn't know it was in New York City. I thought he was here. Maybe he was riding in New York City. That's right. The cat. Okay. Kept you way past bedtime. Whoa, way past bedtime. So, we'll see everybody bright and early tomorrow in the chat room. We'll see you then.